Hi, folks. This is Sean Hyman from The Logical Investor, and coming to you from the new location. My house on the lake sold to close Tuesday. It's supposed to close Monday. They had to delay it one day because there was something on the buyer's end that was held up. So that's done. I'm out of there. I'm into an apartment while we wait for our house to be built. We're doing a new build in the same vicinity as where we were at before, and they probably won't even start building on that street for another month or two, and then we got another 5 or 6 months after that. So I'm probably here for a good 8 or 9 months, and then we will make one last move into that house, which will be a new build, but will cost a fraction of what my last house costs, and about half, a little under half. So so that'll be a nice breather. And so thank y'all for the ones who prayed for all that to go through. And anyway, um, so if anything sounds any different at all, I am in a different room and different internet provider, different internet connection. This apartment doesn't have quite as fast an internet connection. Well, it's not anywhere near as fast as what I had at my house. So if there's anything quality-wise difference, something like that probably would be it. But what we've got right now is what we've got for the next 8 or 9 months. Um, so I wrote an article today because this is something I've been wanting to touch on for a while, because there's a number of very common investor mistakes where they're putting their focuses on the wrong things. And one of them is, I wrote about debunking an investor mistake, focusing on the number of shares and price per share. And just a short, tight article where I give some examples of high price per share stocks and how they performed. And a person would have owned a lot lower number of shares than than they would have in your typical stock, but how the performance was over time in these stocks. And it basically debunks the myth that number of shares, if I have 1,000 shares of this, it's better than having 100 shares of this. Not necessarily, and your return's not necessarily going to be better. Or somebody that says, well, I'm going to buy this $5 stock rather than this $20 stock because the $5 stock can double so much faster. Not necessarily. And then I go into penny stocks, which are crap stocks, which you can own a boatload of shares of, and you own a whole lot of nothing. So anyway, go through that if you would, and for those of you who will, share that on your Facebook by clicking the Facebook icon there, and for those of you on Twitter, you can share it there as well. This is a free article, would help many people. There's just a lot of stuff that that retail investors make a mistake on, and there's stuff that seems right to them but is not right. And so I say at the bottom of the article, if you're a newer investor or if you have been an unprofitable, unsuccessful investor, then why should you trust your thinking? You shouldn't. In fact, you should find pros that have been successful, and as quick as you can, exchange your thinking for theirs. And that's how you grow the fastest in investing. If you go by what seems right to you and trusting your own judgment, you're always going to be behind. And so I'm not saying I'm at the top of the ladder, and I'm doing the same thing I'm telling you to do. So when I read after Warren Buffett and Sir John Templeton and Peter Lynch, and listen to Buffett's shareholder meetings and reading books and stuff like that, what I'm doing is I'm listening to people who have been doing stuff 30, 40, 50 years when I've been doing it like 25 or so. And so I'm doing the same thing that I'm asking you to do. And I'm always willing to exchange my level of thinking for their level of thinking, because that's how I got to where I think like I do today, is because I was willing to exchange my thinking so many times over through the years, and that's what took me forward so much through the years in investment knowledge, because you will find what you're taught, what you hear, and what you presume. Typically, all those things are normally wrong or mostly wrong. And there's a small group of people that have been doing this long enough that have had to go through that and realize and debunk all that and realize that all that's crap. And they've learned what really works and what really matters. And it's why a smaller group of investors are ultimately typically successful and the masses are not. It's because the masses do not have the right thinking, and they also do not develop the proper emotional, psychological temperament for stock investing. And notice I said they choose not to develop, because anybody can do it. So it doesn't fly when somebody says, well, I'm just quick-tempered or I'm impatient. You have total control over your character. Now, I'm not saying something may not be a challenge for you. It may not be more of a challenge for you than the next guy because of whatever your natural bent or inclinations are. But because some people have it easier, uh, in that department than others. But it's all conquerable. It's all doable. One of the best exercises you can do is read the Bible, because it will change your thinking and it will empower you. It will strengthen your character. It will strengthen your spirit on the inside, which is the real you, which will enable you to have power and control over the rest of the parts of you, your mind, your body, etc., and help you so much in those areas. So the power of the Word, the power of prayer, the power of church, it all helps you with your character development, your emotional control, which, believe it or not, spills over into helping you with your investing. So if you ever wondered how in the heck does church and God and religion and the Bible and all that kind of stuff help you with investing, and how does that even relate, that's how it relates. So the great faith that I have today, has been developed through the years of reading the Word of God, trusting God, and it has spilled over into giving me confidence in other areas of life, because I'm so aware that God is with me, that God is teaching me, that God is leading me, that God's directing my steps. And so that gives you a lot more confidence, excuse me, than the person who is solely depending upon their efforts solely, their IQ solely, no matter how high it is. There's just a different realm there that those people operate in than the ones that just solely depend upon their talent, even though their talent is God-given. You can come to the end of your talent, and God can take you and show you things that are so much greater than your talent, skill, ability, or IQ would even normally get you to. And so you need to pray that way. God, show me things that are beyond me, so that I can know these things. Teach me, illuminate things to me, because it's not just the Bible, but God will illuminate to you things in everyday life, including investment knowledge, and helping you soak that up as well. So anything you struggle in, you say, well, I'm a new investor and I barely understand some of this stuff, and some of the stuff's Greek to me. Ask Him to help you to understand it, and then immerse yourself in the weekly videos, the monthly newsletters, ask questions on the site, etc., and see what God does with you over the next 12 and 24 months. It will be amazing. Okay, so I feel like that was a word for somebody, and that's why that was not pre-planned. That was definitely off the cuff, so that's definitely for somebody out there. So the S&P 500 keeps getting rejected more recently at the 2,900 level, and on the longer term around the 2940, 2950-ish level. And we'll just go to the daily chart and take a look at that real quick. And you'll see that 29 has been rejected over the last number of days, and the MACD, the RSI, keeps slumping over. The 2800-ish level keeps getting tested more. So, in the near term, this thing could do, it could go up, it could go down. But over the long term, where's it going? It's going down. How do we know that? Because valuations are too high, PE levels are too high, and so price has to come down relative to earnings, and that's how those are compressed, and that produces eventual value. So we know over time this is heading lower, and we've already seen earlier phases of it happen here, and then there's one to come that will be far greater than what we see right here. So another thing I want to hit while I'm thinking about it is I was watching the chart of the U.S. dollar. The U.S. dollar had quite the reversal today, up through its top Bollinger Band, and a quick reversal downward to where it closed with a long wick up top, and that means there was a lot of selling that happened, and the sellers held it down into the close to where it was nowhere near its highs and well within its Bollinger Band. So many times when that happens, like here and here and here and here and here, you will have some the dollar head back at least minimally towards its 200-day moving average. And so if that happens, that alone can give some of our metals positions and things like that a boost. So point that out. Also, before we get into our positions, I wanted to look at Apple. We don't own Apple, but why Apple is so important is because Apple is one of those few companies that have reached $1 trillion market cap. It's one of the largest holdings of institutions. And so when Apple starts rolling over, that can be a problem, and that can help stoke selling in the overall broader market. And so Apple had its highest high here around 230.78, and then went all the way down to 140, came back to 214.48 before breaking back down, breaking this upward trajectory right here. And so we've got a lower high here than here, and we're probably on our way to a lower low than what we had right here in time, with it going up and down, and having good days and bad along all the way down. But I point that out because with Apple rolling over, with some of the FANG stocks starting to weaken, those all could weigh on the overall market. Here's Facebook, which is the first one in the FANG. It had ran up. This is likely wave 5, A, B, and then with C to come. And then we've got Amazon, which is the second one in the FANG. Ran up. This is likely wave 5, A, B, getting ready for C. Then you've got Netflix. Netflix ran up, wave 5, parabolic move, far away from major moving averages. Has wave A here. I believe this is wave A, and I believe this is wave B, and I believe we've got wave C still to come. Look at how much the MACD has slumped over and had a sell signal slumping here. So it's looking negative, and it's still a mile away from its 200-week moving average, which shows huge risks. So FAN, and then we've got G. The G in FANG is Google. And so Google, this one is a little bit harder. This could be a 5 and an A and a B that was that slightly higher fake out going into a C, or we could be the traditional 5 with the ABC still to come. Either way, this is pretty much like a double topping area right here. This is definitely close enough for a double top, 1291.44 and 1296.97. So about 5 points away on the $1,290 something stock is pretty much right there even. So so I'm looking for this to head much lower, way under its 200-week moving average before it's all said and done. We're seeing slumping MACD, slumping RSI, and the price is still a good bit of ways away from its 200-week moving average, showing quite a bit of downside risk there as well. So you've got the FANGs, you've got Apple, which some people put Apple in the FANG, FAANG. Those are rolling over. One that's been one of the stronger among them has been Microsoft, which is not a FANG, but it's been one of the high-tech stocks that has been highly concentrated by institutions. That's another one that as it starts heading lower, will help unleash a lot of broad selling, because a lot of these stocks are very high market capped. Amazon and Google and Apple and Microsoft and so forth, they have very high market caps. And so there's some of these indexes that are market cap weighted. And so when these handful of stocks go down, they're going to make huge dents in the overall indexes and bringing them lower. And that encourages huge waves of selling just off of a handful of stocks that were highly influential within the index. But look at how far Microsoft is away from its 200-week moving average. So, this is going to have a massive sell-off as well. Which brings me to our first pick, GLD. I think it's one of the greatest places to be in light of the volatility, in light of the overvalued market, in light of many stocks being in wave 5s or Bs and ready for their next moves lower. Those are all, and with the overvalued dollar and it potentially heading lower, all of those are good news for gold. And so gold had its ABC downtrend in here coming into 2016 and has been building a base sideways, getting ready to head higher. MACD's perking up a bit, RSI is perking up a bit. The ETF is holding right above its 50 and 200-week moving averages. So again, I'm looking for the next major move to be higher. This could be a 5-wave sideways consolidation, wave A, B, C, D, and then E. E's typically don't go all the way down to where the lows are here. E's tend to be, a third or a half or whatever of the move and then push higher. So we really could be not far from the next major breakout in gold, and a market sell-off could help encourage that. So then we've got FXB next. So I'm looking at a lot of these on the longer term chart today for the most part. So this had a massive A, B, C downtrend, which ended here. People think that the pound is low here, but they forget that in late 2016, early 2017, it was in the 117s on FXB, and here we've only hit 121, and today we're at 122.74. Not that it can't go any lower, but so far it hasn't come real near the 117.48 low here. I believe this is the end of wave C. I believe this is wave 1. I believe this is wave 2, which we don't know if we're done with wave 2, but we could be. But two of the reasons why I think that is not only just because we've got a higher low here than here, but also because we've got such massive selling volume here and slightly less here. And two of your biggest selling spikes and points of maximum pessimism tend to come towards the end of wave C and tend to come also towards the end of wave 2. And so the volume tends to mirror and reflect that. So matter of fact, some of the questions I get asked the most about on the site that you can tell cause people some worry or concern when you look at the stock. I mean, I can almost not look at the stock and know that the stock is either in a wave C or a wave 2 because of the level of concern that the subscriber will have. And sure enough, while I'll go to it, it'll either be wave C or wave 2, because that's when sentiment is the worst. That's when negativity is the highest. That's when people are most apt to make the stupidest decisions concerning their stock. Are those times, and you see that here. This is a record of people doing a ton of selling here, and then as this heads higher, they're going to be kicking themselves and wishing they hadn't done that. So over time, this is going to head overall much higher, and whether it goes lower some before heading higher, who knows? Nobody knows. But overall, this will head higher over time, and you see too that the selling volume continues to get less negative. I mean, so far, like I say, it's not that this is massively less negative, but it is less negative. And then you're just about to the end of the week here. So, I mean, you can tack on one more day's worth of volume there, but it's still, a lot less steep so far than what we've seen here. You've also got the MACD perking up. You've got the RSI has been perking up some then, and even perking up more even lately. So those are good signs for FXB over the long term. And then next we've got EWW. So with this global trade war and all this sell-off, most of the emerging market ETFs that I see have been just getting pummeled, and they'll be fine, but they're still getting pummeled in the near term. And EWW has been very, very resilient relative to those, so that's something to take note of. Um, and this one is a little sloppy and choppy, but this is probably A, B, and then C ending here. Here's your point of maximum pessimism. This was obviously less pessimistic on this spike, and the selling spikes here lately have been far less than even this one, which is good. So this is likely your ultimate bottom here, and then we rallied up. We had some pullback. The question is, do we have more pullback, or is it done? And the answer is nobody knows. It could just, head up from here, or it could do some type of, pretty decent sized pullback and then head higher. Either way, it doesn't matter. The ETF is priced cheaply. Cheap PEs don't stay that way forever. So where is it going over time? It's going up. So that's why it doesn't bother me if it goes down and then up, or just up, because over time we know where it's going because of its valuation. So EWW is one I'm definitely bullish on, probably among the most bullish of the emerging market stocks right now. So GDX has had its ABC downtrend in ABC that ended coming into 2016. You'll notice a lot of ABC downtrends in a lot of our stocks ended there, and then we're in the early stages of the long-term uptrends, which this is wave one, this is a three-wave pullback, wave two, and we are either in or about to be in wave three. I think we're probably in the early stages of it, but it's a little hard to tell. But ultimately, I see this, heading ever higher. Again, whether it has something lower first before heading higher, and nobody can say for sure. But your peak in selling was right here, and then it's been dropping off quite a bit ever since there. And then your selling spikes were dropping off even considerably more ever since, and even some of your bigger spikes lately have been buy spikes, so that's good. Your RSI is kicking up and improving. MACD doing some of the same. So I believe that as gold breaks out, we'll see a nice breakout in GDX, and so it's one that should do well over time. I just had sold a put on GDX and closed it out not long ago. This one, when it had come down into the Bollinger Band, at the bottom Bollinger Band near the 200-day moving average, and already had a major three-wave correction here, and a even more near-term three-wave correction there, and the selling was dying off overall. So this is one that I had sold a put on, so took in premium to not to want to own the stock, but really just to get the premium off of it, and then close it out to capture a lot of the premium. And again, that stems from one of the strategies in my options reports. But anyway, that was GDX has been one that since it's volatile, it's been working nicely towards the end of the bottom Bollinger Bands, and the puts tend to have more premium in them than calls. It's been that way since after the 1987 stock market crash. So it's one reason why I would rather sell a put than sell a call in general, because of that added extra edge that adds up over time. So I've never done the studies on that, but I have listened to the people who have, and that was their findings, and I can certainly believe that. So LPL, this is one that is very volatile. To think it'll be otherwise, you'd just be kidding yourself. But it has basically, a support zone roughly in here that, that it can spike slightly below at times. And then it's got, for the most part, a resistance zone right in here where it's had obviously some spikes above before, but for the most part there. And so I'm looking for this to head back up to the top of the zone over time. We won't be in it all the way up to the top of the zone because we've got all three of our averagings in. So by the time we get back to where our first entry point was at 1345-ish, so around there, we will be well up on our overall entire position and still only be, at the midpoint or just past the midpoint of this long-term volatile range. So expect volatility. When you look at this chart, it should be screaming it to you from, 7s to 22s and back down to 7s and back up to 16, almost 17s and back down to 10s, then 18s, then 8s, then 17s, then 6s, etc. So doing that all that time over the last decade, why would you expect that stock to change its stripes and act differently now? So you shouldn't. So one thing I will also note is the selling volume here hasn't been near as high as it was at this bottom or around this bottom as well. So that's a bullish sign for us. It's also quite a bit of ways under its 200-week moving average, and over time there tends to be a snapback towards that and then some. Like you see here, here's the 200 and it snaps back past it. It's well under it. Actually, two times here it snaps back to just shy of it. Here it snaps back to well over it. Here's another time it was way below the 200 week, and what does it do over time? Snaps back towards it and then some. So now this takes time and it's not instant, but it helps you to target where a stock is likely to go at a minimum, region there. So this snapping past its 200 week is going to get us into a nice profit even long before it goes up towards the high end of that range. So, but there will be a lot of volatility, and there could be added volatility because of the trade war and all that kind of stuff. So if it even dips lower near term because of the added dimension of the trade war, don't think anything strange about that. So BBBY had its ABC downtrend here, a very long C over multiple years, bottomed in coming into 2019. It's amazing when you look on long-term charts how many trend changes happen coming into New Year's. Like some of those other charts, we would see at the end of 2016 or 17 a trend change upward. That's because a lot of institutions reassess things from one year to the other, and they'll start redirecting their money elsewhere out of something overvalued and into something undervalued. And it starts this theme among these big institutions that they start piling in together, and it changes the trend direction, going into the to the new year. So so far the Bed Bath & Beyond has been heading notably higher. Now, some of you are out because you averaged down very nicely and you've already had your big returns and you're done and you're out. And if you are out, I don't encourage you to get back in. But for those who are still in, obviously I have confidence in the stock. Here is a breaking of this long-term multi-year downtrend line here, the C wave. For 1, 2, 3, 4, a 4-year downtrend line that's been broken, which is a positive. The peak in your selling was right in here, and then it kind of flattened off here, and then it's been declining quite a bit ever since. And then one of your biggest spikes, of course, here, buy spikes, is right there, a massive, massive buy spike. So that's a positive as well. The RSI has been perking up a bit overall and a bit more even lately. The MACD has been perking up for a long time, and those can sometimes have a good bit of lead uh, lead time on them, but they have the benefit of showing you what the stock is likely to do in the future. So when RSI starts firming up, MACD starts firming up, those do that first, and they tend to show you that the price firms up and turns around as well. So I'm looking for BBBY to head back at a bare minimum towards its 200-week moving average. So, and this one doesn't have to go near to that for those that are in it to be nicely profitable, because you've got all your averagings in, or you should. So really, with this just going to say 21 or so, you would be really nicely up on your money, versus it not even have to make it up to 30 or 31 or something like that. So so anyway, very pleased with where that's headed over time. Keep in mind, with these big down days that we have had, of course that can affect most of our positions. Our defensive positions are the ones that will resist that the most. GLD, GDX, SLV, those primarily. CAJ has been acting as a defensive asset, so institutional money flow may be flowing there as just a value play. But the Dow alone today was down around 300 points, and at one point down about 400. So you have to take that into consideration. And anytime the Dow is down by a sizable amount, that's not a typical day. Of course, it stands the chance of taking down some of our stocks for a period. But all that does, volatility is the investor's friend. So if the market takes our value stocks down lower, all that does is allow you to get in your lower break-even prices and to get cash allocated to those stocks at the prices that I have given, the averaging down levels that I've given at the bottom of each newsletter. In the portfolio section of the far right column, I've listed out the averaging down points, your second and third averaging down point, where you should get into the stock. So without the market pulling back, sometimes you may not get those averaging down points. So the market pulling back is your friend. I heard somebody who was at a Warren Buffett shareholder meeting, and he was noting that Warren Buffett had made the comment that he could teach investing in colleges and universities so much more simply than all these theories that they teach. He said, I could teach some very basics that I could teach people pretty quick on how to find a solid company and how to value a company. And he said, and that would be the first course, the first thing. And then he said, then the only other thing I'd have to teach them is how to control their emotions and how to deal with volatility, and how to teach them to see that volatility, which is typically to the downside, is your friend, is the investor's friend. And so as long as the asset is solid and was a value in the first place, then the market driving it down further just made a good company even that much cheaper, which will make your long-term return likely even that much greater. So something to keep in mind there. So back to this Dow chart, I mean, getting real toppy around the 26.7 to 27K mark. So 26.6 here, 27 even, 26.7 here. So this has a ton of resistance here. RSI heading lower, MACD heading lower. Notice how much slumping is there. And again, what these indicators do at first, the market eventually typically does in time. And it also shows that there's a lot of weakness there, and that the upward momentum is slowing as the market had gone somewhat sideways, and the RSI and MACD had both were losing steam. So it's their own warning signs shooting up the red flares for those who are paying attention. Okay, so next we have CAJ, which I was talking about earlier. This one has been doing better here recently. This is one of those that some people had worried about and second guessed, and why is that? It's because they got fixated on price and not on fundamentals. So if you fixate on price, when price goes down, your emotions are going to go crazy. When the price goes up, you're going to be emotional in the other to the other side of the pendulum, and you need to be focused on fundamentals and how solid something is. Markets are not efficient. Markets are fickle, and that's why this can go down, down like this and back up like this within 30 or 40 or 60 days or whatever. Markets are not efficient. They're fickle. I mean, here, CAJ goes from 31 down to 25, and then a few months later, the market decides, hey, it needs to be valued back at almost 30, and that's just within a few months, not years, a few mere months. So markets are not efficient. When something's going down, it doesn't mean it's bad. It doesn't mean something's wrong. It means investors are emotional. Investors are skeptical. It means the sentiment's bad. It doesn't have anything to do with whether the company should be owned or not. So for whatever reason, a lot of people have this wrong theology of if stocks are going up, I should be owning them and buying them. And if stocks are going down, oh no, maybe I missed something. Maybe it's a bad stock. Maybe it's shouldn't be owned, and maybe I should dump it, which is the stupidest thing in the world if you got a good solid company. But again, it's why fundamentals are the very most important thing that we do out of our three-pronged approach of fundamentals, technicals, and sentiment. Because if you are solely a chart watcher and watch every little tick and shake and whatever up and down all over the place, your emotions are going to be attached to that, and they're going to be the same way. When the market or your stock is up, you're going to be up. When your stock is down, you're going to be down. And when you're down, you're emotional, and when you're emotional, you're going to make stupid decisions. So that's why we call the newsletter the logical investor and not the illogical investor, or we don't call it the emotional investor, because most investors are illogical and emotional. They don't handle volatility well. They don't handle down moves well. And you have to get to where you decide and you buy into what I'm teaching here, because that is part of the secret sauce of being a successful investor over time. It's what Warren Buffett and Charlie Munger have mastered, and I keep myself immersed in it as well, so I'd always stay mindful of it also. But a stock is a company. It's not just a stock. It's not just a price. It's not just a squiggle on a chart. It's a company. That certificate, that share is a piece of a real company. And when you forget about it being a stock and you think about it being a real company, and you go back to its real fundamentals on Yahoo Finance, or go back to the newsletter where I gave the recommendation, where I talk about the fundamentals and how solid they are, then it causes you to view the company in such a different light when it's declining or when it's rising. Doesn't matter. So back to CAJ. Point of maximum pessimism on the daily chart was here, and it's come down quite a bit lately and come down quite a bit more even recently. MACD's been heading higher, which is bullish. RSI has been picking up steam as well here lately. So this is one that I'm very bullish on. Also, for those who study chart patterns, this could be a bullish cup and handle pattern where you've got your cup right here and your handle right here and the breakout here. And so if so, then you'll see this, head way up into the future over the months and year or so ahead. So CAJ, again, very bullish on. IBM. IBM is very volatile. Let me get this typed in right. It can be up a buck or two or three one day, down a buck or two or three the next, up 2 or 3%, down 2 or 3%. It's just very volatile. So you don't really want to fixate on that. But and it's got both upside and downside volatility. But downside volatility is the only one that causes your emotions to want to engage and that you have to manage. So when this goes from 148 to 103, that you have to manage. From 103 to 143, you don't really have to manage. Yet that's volatility and that's volatility. But a lot of people only see volatility as downside, not necessarily upside. And it's funny how this can go from 103 to 143 and then correct to 130, and then people will second guess it, forgetting that this pullback is in the context of this massive move here. So that's what charts remind you of. We went from 103s to 143s. Isn't that a little unusual in that few months' time? Of course it is. So would it not be rational for that to pull back to some degree, whether it's to this degree or whether it's to a greater degree, before heading higher? Of course it would. So we just don't know which path it's going to take, and we don't have to know which path it's going to take because we know that IBM's fundamentals are cheaper and going to go, that PE multiple is going to expand over time. We also know that this is a stock that is big enough, has a big enough dividend, did not get run up and inflated in the last market upcycle. So as stocks roll over and money goes from overvalued stocks to undervalued stocks, IBM is a prime candidate there. Now, it doesn't mean that IBM may not drop some with the market in the interim first before it kicks in and heads higher, because that could happen. Excuse me. But what I like is that your maximum pessimism peaked here, and then it started selling off a lot less, and it's been a lot less, more so even after that. So your biggest spikes were here. That's why this is likely your bottom, and massive run up here. So it just only makes sense that you would have a shallow or a fairly deep pullback before heading higher. That's just typical market mechanics. Your MACD is heading higher overall, which is good. RSI has been picking up some here lately, so that's good as well. But I'm very bullish on IBM and its prospects over time, and then also with its Red Hat acquisition, that can be good for it as well. So KHC, Kraft Heinz, Warren Buffett still owns a lot of this. This will not always stay in this range. Right now it's in this real boring range right in here. That will not always stay that way. It will eventually break out of that range and head back higher. Now, here's one thing that sometimes happens out of these ranges is sometimes there will be one last break lower before heading higher to shake out all the rest of the remaining people who were sitting on the fence and wondering whether they were going to stay in it or sell. And so all it's got to do is break a little bit below this range, and they're like, I'm out, and so that can create its own wave of selling before the institutions come back in and run it up. So it could pop straight out of the top and head here, but this doesn't take any emotional management at all. This route here does. So that's why I give you both case scenarios. Your peak of maximum pessimism was obviously right here. I mean, you can see that from across the street, if you're looking at that chart. And that has dropped off tremendously, which is a good thing. And then you've got the RSI has been firming up a bit too, which is another good thing. So, got great confidence in it over time. ENI, of course, with oil was down about 6% today. But again, you have to keep your focus on where is the trend in oil. So because oil will be volatile both on the upside and the downside. So let me draw that again. So when you look at your long-term charts, you get clarity, a lot more clarity than just with your daily charts. So here's your A, B, C downtrend, ended coming into 2016. So here's your first move up. Here's your major wave 1, and this is wave 2. We don't know if this is the end of wave 2. It could be, or we could be seeing a little bit deeper wave 2. So if we're done with wave 2, then we probably have some type of pullback and go higher. If we're not done with wave 2, then we could see it go a deeper 3-wave back, but still higher than what we see here, and then head higher here. Either way, this is still the bottom of wave C, which means this is uptrend even with its pullbacks along the way. So your focus should be that oil is trending higher overall. We've got a golden cross here. We've had a massive move from 26 to 76, almost 77. So again, this doesn't concern people at all. This does. So it's funny how it can go from 26 to almost 77. People think nothing of that, but then they get shocked, almost knocked out of their chair when it goes from 76.90 to 42s, and they go, and that's when they doubt it. It's like, really? So all this happens, and you don't think that it can pull back a decent amount. So an unusual move to the upside, where it triples up in just a couple of 2 or 3 years, and to think that unusual activity happening on the upside, yet there can't be some volatile and unusual activity happen to the downside to retrace and correct part of that move, would be foolish. So again, looking for oil to continue higher over time, but again, it will be volatile with trade wars, with a slowing global economy, with an overinflated dollar that is undoubtedly at some point going to have to come down, and when that does, that will help oil. So, but we're not dependent upon the dollar coming down for oil to prosper. Obviously, all this happened without the dollar necessarily declining. So, but with oil declining some near term and 6% in a day, of course, that affected ENI. So oil itself was down almost 6%, 5.71%, and ENI was down 2.63%. So it wasn't down near as much even as oil itself was. But ENI again, looks great. Very bullish on it. Here was your latest ABC bottom just after 2016, and then you have this big run up from 21s to 38s, and so of course there needed to be some type of pullback. We don't know whether this is the bottom of it or whether it goes a little deeper before it's all said and done. So good news is we don't have to know. Sometimes people think you got to know every little wiggle and squiggle and why it happened. Even commentators on TV don't always know why every little wiggle and squiggle happened, but they'll go find some reason that it may have happened. So people feel like they got to know every little thing, every little move, and they just don't. So if you ever listen to Warren Buffett, he'll tell you, I don't know what the stock's going to do tomorrow, next week, or next month, but I've got a great feeling, not a feel, but a great assessment of what I believe it's going to do over time, over 3, 5, 10 years, whatever. And he has almost no opinion in the super near term and has great opinion in the long term, and he does real well in it. So you don't have to know on an intraday basis, or if something retreats for a week or two or a month or two, what's causing it or why it's happening or whatever. I mean, it's really irrelevant as long as you know what's supposed to happen over the long term, which we get from fundamentals and from valuations. So from fundamental strength and fundamental cheapness. So this was a massive zip up from 21 to 38. So it 28.90 might be the bottom, and it just overall head higher from here, or we could get a bit deeper 3-wave pullback to where this comes back some more before heading higher. Any of that's possible. What I do like is your RSI is firming up. The MACD has been firming up overall. Selling volumes continue to drop, which is good. So lots of good facets there for the bull side. And then we've got SLV. So silver had its ABC downtrend end right into coming into 2016. Here's your wave one. Here's a sloppy, choppy, and long wave two, which probably ended here at 1311. We don't know for sure. We're at 1368 right now. So I'm looking for gold to do great first, and for silver to trail it and to eventually do more than gold percentage wise. So I'm looking for this to head quite a bit higher over time, and once this move is broken right through here, then we get above the 15s or so. This will probably go from 16 to 20 or 24 a whole heck of a lot faster. When it really gets some traction. This has been down to sideways for several years now, 3, 4, 5 years arguably, and so long ranges produce long, strong trends. So I'm looking for that to do well. You've already got your RSI strengthening. Your MACD in the near term has strengthened some, and so people haven't been bullish on silver in about 7 or 8 years, and that's why I believe that the pendulum has swung too far, and it's time to be finally a buyer of silver through SLV. So, and then finally we're back in CHL, of course, which this one we let it drop. So we sold out way up here, let it drop back closer to its moving averages, and then got interested in it. And of course, we knew we probably weren't catching some bottom, because you're almost never catching a bottom when you're getting into something and buying it, just like you're almost never catching the absolute top when you sell out. Nobody does it. Buffett doesn't do it. Sir John Templeton didn't do it. Peter Lynch didn't do it. So why should you or I do it? Yet calling bottoms and calling tops is a fixation of retail investors, and it's one thing that keeps them frustrated and unsuccessful, because again, their focus is in the wrong point, the wrong place. Their focus should be getting the meat out of these moves and buying solid companies at low valuations and averaging down to get even lower PEs and lower prices, so that as the price rebounds, they can have this really nice return, rather than, oh, did I buy at the bottom? Did I sell at the top? And then being frustrated if they didn't buy at the bottom or didn't sell at the top. I mean, it's a dumb expectation to set that is just simply not going to happen. Like, in all my years of trading, in all my years of doing newsletters, yeah, there might have been a time or two where a bottom happened to be caught or a top happened to be caught, but and that's the truth of the matter, is happened to be, because I couldn't tell you, yep, I knew for sure that was the bottom, so we bought. Yep, I knew for sure that was the top, so we sold. No, you just knew the risk and assessed the risk and invested accordingly, or sold accordingly. So this retreated a lot. Investors were uber bullish on it here. It got slammed a lot in the near term. They're back bearish on it here. And so that's when I started to get interested in it again. And again, we've got deep averaging down points, which you can see in the portfolio section. And if it were to reach those points, then you can get into it. So we're not too terribly far away from its first point, and that second point is quite a bit of ways on down. So again, this one, massive company, massive amount of client base set at services, zero debt, massive dividend, lots of reasons why I like the stock. It's just that when it has zipped up here and gotten so far away from major moving averages, both on the weekly and daily chart, there's no way I could justify holding on to it, because I knew that the risks of it doing what it has done were there, and I saw those risks ahead of time. And just because the risks are there does not mean it always will unfold, but it means the risks are there and the likelihood of it's there. You get a guy that walks across a tightrope wire, there's a huge risk that he falls. Doesn't mean that he can walk across it and not fall. Sure. But the risks were there either way, whether he fell or didn't fall. And so Sometimes people confuse risks with foretelling or forecasting for sure 100% what a stock is going to do. And nobody knows for sure 100% what a stock is going to do. We know what is likely based off of risk analysis. So we know that when these stocks get way away from these moving averages, their propensity is to slam back towards them. So it's a way of analyzing risk. We know that sentiment gets overly bullish when these things zip up too high and too fast, and that they're ultimately unsustainable. We know that that these parabolic moves that go up like this at these steep angles are typically not sustainable, and sometimes they're longer than than others. I mean, there's some long ones here, no doubt, but in every one of these cases there was massive recoils, and that's not the only ones. I mean, here and here, and I mean there's a number of them on the chart. So when you get those massive steep angled moves that get far away from the moving averages, your risks are high. Does it mean that it has to top and that it can't go higher before it goes lower? No, it doesn't. But what it does mean is that you've got this great gain. And the risks are high of it retreating. So therefore, the risks of losing your great return are there. So why do we want to have a great return in hand today and risk losing and giving all that back when we can mitigate that risk by selling and let the stock correct, and then when it gets to certain appropriate levels, valuation wise and on the chart wise, then have a re-entry and your second and third ones on down. And by the way, we are in the stock lower this time around than we were last time around. Last time around we started at 50.67. This time we started at 47.75. And we're just about to hit if this goes a little bit lower, we'll hit our first averaging down point here in a little bit, which will bring our average break-even price even lower, and which helps to give you a slightly fatter dividend yield, slightly lower PEs, and quite a bit higher overall return. So again, very bullish on the stock in its own way. Long term, it's defensive because of its size, because of its client base, because of its dividend, because of it having no debt, etc. So there's a lot of reasons why long term it's defensive. That doesn't mean near term it is. Near term it can do anything. You got to remember, it's a foreign stock, foreign country. It zips up a lot, it zips down a lot in a very short amount of time. So therefore we expect volatility, because you look back over the last decade and it's the epitome of volatility. So it can have 10 or 12 point swings in very short amount of time. And so that's just to be expected. That's the nature of the beast on some of these stocks. So when you see its habit, its personality, you can't expect it to change. Just like if your spouse is bubbly, you can't expect them to be, docile and just subdued and almost introverted or whatever. I mean, you can't expect that. And if your spouse is, laid back and easygoing, there's no way that you're going to change him or her into being the life of the party and whatever else. I mean, they are what they are. And many times you're going to find that a lot of the habits of these stocks, they are what they are. It's almost like they have their own personality. And so when you look back over the last decade and observe that volatility and those ups and downs, not only do you observe trends and things like, and supports and resistance and all that, but you can observe volatility habits, because some stocks are a heck of a lot more volatile than others. Okay, that is it for this week. Thanks so much for listening, and God bless. Bye-bye.